Hello, everyone. Today on the Final Bar, I'm talking to Matt Maley, editor of the Maley Report, coming to us from Boston. We'll talk about some of the big picture charts he's focusing on to make sense of this macro environment. A choppy day for stocks with the S&P, the NASDAQ essentially unchanged for the day, but a lot of movement underneath the hood. I was talking with my guest Matt Maley earlier before the show about Apple continuing to push to the downside. That's a painful chart when in a painful moment when stocks like that don't hold support. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of technical analysis, using the technical toolkit, the best practices of technical analysis to try to quantify investor behavior, better learn the lessons of market history, and better understand market dynamics. And when we talk about this market environment, very, very clear we're in a distribution phase. I think it's hard to deny that. So the question remains, how low do we go? What signs do you look for that there's a bottoming process? What opportunities are there at the time when the market is struggling as it is? Today, a little bit more of a digestion day. So yesterday was certainly back in the distribution phase, but 2 days ago on Tuesday's show, we talked about sort of that choppy digestion day. And that's how I tend to think of this sort of a market environment. You have different types of action to a particular day. It could be an accumulation day where you see better buying. It could be a distribution day where you see people taking risk off the table, or it could be a choppy sideways day, which I'd call a digestion day. This is where we've had the big meal yesterday. Now we need to kind of digest it. And this is where the market resets a bit to determine where it's going to go next. But while the S&P has netted out to a zero, you'll see a lot of movement underneath the hood. And that's where I think we want to focus through the course of this show, is paying attention to some of the individual names and themes that are really still on the move. We have great guests coming through the Final Bar. This week has some of the better ones. I'm excited to talk to Matt Maley. We haven't had him on the show in a little while. We'll hear what charts he's paying attention to. Next week, 3 solid guests lined up for you. On Tuesday, the 17th, we have Ari Wald, the technical analyst at Oppenheimer in New York. On Wednesday, the 18th, Mark Chaikin, who's really a legend in technical analysis. Some of the technical indicators like the Chaikin money flow, accumulation distribution, and others really Mark popularized and developed earlier in his career. So we'll see what he's looking at. Then on Thursday, the 19th, we have a financial advisor perspective. Louis Yanis, who's the founder of WealthNet Investments, coming to us from the Denver area. Will share with us some of the concepts he's looking at recently. Let's continue on with this show, looking at the market recap. Let's pay attention to some of the guidelines we can see in the markets themselves. As I was taught early in my career, when in doubt, focus on price. Price will tell you a great deal about what the conditions are like. Let's see what the evidence is telling us now. The S&P, as I mentioned, the NASDAQ Composite, NASDAQ 100, all very, very close to a zero for the day, unchanged. The Dow down about 1/3%. And small caps, this S&P 600 up over 1%, the best performer of this small group of major indexes that we're tracking here. The VIX coming off a little bit, but still just below 32, which is remaining fairly elevated relative to historical averages, particularly in the last couple of years. Other asset classes, very quickly, you have bonds that actually had been in quite a bit of a fluctuation. About an hour ago, when I was starting to prepare for the show, the TLT was actually making a new high for the day. It was starting to push higher, and it felt like the sort of safe haven move. We saw a bit of a reversion going into the close. The TLT actually finished in the negative, and interest rates overall coming off just a bit, with the 10-year yield currently around 282. The dollar index continuing to push higher. And, when I'm asked a lot of times in this sort of environment, is anything going up? And the answer is, well, yeah. And I think that's where technical analysis can be really helpful. What charts actually are working at a time when it feels like nothing else is? And one of the trends that has been fairly consistent and fairly reliable, the dollar index. We're looking at the UUP here, which is up about 0.9% for the day. Energy commodities, you can see precious metals down, but the GLD, the SLB, the gold and silver ETFs that we track both down in a pretty big way. Commodities as a whole, using the DBC, up about 0.5%. Energy stocks were up about 0.5% as well. Cryptocurrencies still a lot of deterioration here, with Ethereum now below 2,000. We were talking about the 3,000 level not too long ago. Yesterday's close, we were talking about, as we were recording the show, we're talking about that next big round number, 2,000. We actually traded below it, traded right up to 2,000, now rolling over once again. So cryptocurrencies in general really accentuating this risk-off feel to the markets. Bitcoin remaining below 30,000 after breaking below that key support level yesterday as well. Let's continue on with the daily chart of the S&P 500. I'm always reminding people, never confuse the bottom of the page with support. And what I would encourage you to not do is look at stocks that are going down. And if your investment thesis is based simply on the idea that it's gone down a lot, that is not a great thesis. I would revisit that. And remember, I was taught price usually goes down for a reason. So the S&P has now gone down from 4,800 in early January to now threatening, just below 4,000 here. So we've lost about 20% off of the highs, and now sort of, teasing around those levels. You're getting close to that level. 4,000 is a big round number. It also represents a 50% retracement of September 2020 to January 2022. If we break that, which I would argue we've now done, even with the bounce today, I think overall the trend remains negative. I think the key level that I'm looking at, and many others as well, is 3,800. That would be a 38.2% retracement of March 2020, that big low there, to January 2022, the end of this bull run that we saw going through the end of last year. That would be a very poetic, sort of classical technical event if you would pull back 38.2% of the way of the most recent bull market and then renew this new uptrend. And so I would say, given the fact that I would consider, many of my peers in the industry looking at a similar level, I would be amazed if we don't get it, at the very least, some meaningful bounce as we get closer and closer to 3,800, because so many people are expecting that will probably provide the bounce we're all expecting. The question, though, is what's next? And that's where I think some of these charts that have been into distribution phase will tell us whether or not that downtrend may be over. You'd want to see things starting to bottom out and maybe putting in a higher low. When I'm looking at the broader set of evidence, yesterday on the show, one of our 3 and 3 charts at the end of the show was this one. This is what I call the new Dow theory. Charles Dow talked about looking at the Dow Industrials and the Dow Transports, and essentially was trying to get the two main parts of the economy, the producers of goods and the distributors of goods. Are they in agreement or not? And what I've done is adapted that to what I'd call a new Dow theory. So looking at the S&P 500, essentially representing the old economy, the NASDAQ composite basically representing the new economy, generalizing a great deal there. And if both of these are breaking to new highs, as they did last November, that is a confirmed bull market phase. When one of them breaks to new highs and the other one does not, as we saw at the end of last year, beginning of this year, that's a non-confirmation, which is the beginning of a warning signal that the uptrend might be exhausted. When both of those are making new lows, which they did back in February, they've done once again here in April into May, that's a confirmed downtrend. So what you would be looking for here is when one of them makes a new low, the other one does not, right? When you get a non-confirmation to the downside. So at this point, with both the S&P and the NASDAQ, undercutting their lows for March, continuing to make lower lows, that's an environment, a market in distribution. And so finding one of those making a new low while the other one does not would be the opposite of what we saw in January. That would indicate potentially some support coming in or some buyers coming in. And we're certainly not seeing that just yet. To finish off our market recap, let's look at some of the sector and thematic movements. We had communication services, number one, up over 1%. Healthcare, number 2, up 1%. Real estate and consumer discretionary essentially tied for third, about 0.75% to the upside. About half and half today. Half of the sector's up, half the sector's down, which makes sense given the choppiness that we see. On the downside, it's a mix of defense and offense, I would say. You have utilities at the bottom down 1%, technology right about the same, followed by financials. And, it's interesting when you think of the financial sector, this is a great set of charts. If you look at things like some of the regional banks, here we're looking at SYF, Synchrony Financial, you can see this clear rotation from an accumulation phase, late 2020 to mid 2021, what I might call a consolidation phase, mid 2021 to early 2022, and then what I can only describe as a distribution phase, right? So you have a pattern of higher highs and higher lows in the first third of a chart. You have stable resistance and support levels in the middle. So highs not getting much higher, lows not getting any lower. That's the consolidation phase when we basically hit an equilibrium. Then all of a sudden that changes. We're no longer reaching the previous highs. We're undercutting those. We're now making new swing lows as the market sells off a little bit. And just today, you have SYF down another 6.5%, undercutting that potential support from March and April. The challenge I have looking at this market, if you ask how come we're not more optimistic given the fact that the market's already down a pretty decent amount, it's charts like Apple that don't hold support, right? Apple had an opportunity about a week and a half ago to tell us that everything was just fine, right? Holding the 200-day moving average, holding 150, which was the support from March, also lined up pretty well with resistance earlier in 2021. That level doesn't hold all of a sudden. We're breaking through support at 150. And so Apple remains below 150 in the short term. This is very much confirming this downtrend phase for one of the leading stocks out there. So what areas of the market are actually working? There are a number of different things we could talk about. And in tomorrow's show, when we do our weekly wrap show, we'll touch on some of the key themes that we can review. I think healthcare is a really interesting chart here. You know, what I was taught, and I was talking with my guest, Matt Maley, before the show, just about getting started at Fidelity. I started there in 2008. A lot of what I'm seeing right now reminds me of what I saw then, which was prices going down, a lot of red on your monitors. But you know, it helps to look at where the relative strength is improving. And the charts of the XLV, charts of the XLU, the utility sector, you're seeing that relative line break to the upside. So while the price on its own is not maybe the best chart you've ever seen, the fact that you're outperforming means you have an opportunity to cushion yourself from potential downside, or at least be in things that are going down less than the broader market's decline. Let's take a quick break. We'll be back with today's guest, Matt Maley. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close. A couple quick announcements before we get to today's guest, Matt Maley, editor of the Maley Report. First off, I will be doing my next webcast with Market Misbehavior coming up next Tuesday, May 17th at 1 o'clock Eastern. It's called 7 Habits of Successful Investors. I'll share with you some of the insights I've gotten from some of the top money managers that I've worked with over my career, some of the habits, some of the routines that I think have allowed them to develop a nice run of consistent success. You can go to marketmisbehavior.com/7habits to sign up for that free event. Also, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and we love to feature one of your questions live on the air. It's actually tomorrow's show on Friday of this week. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We're so lucky to have knowledgeable guests like Matt Maley, Katie Stockton, Mark Chaikin, many, many others coming through the Final Bar. You can see all of their previous commentary and all of the other great content we produce for you for free at StockChartsTV.com, or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Matt Maley. Matt is the founder of the Maley Report, also spent much of his career at Miller Tabak, coming to us from Boston. Matt, it is great to see you. Welcome back to the show.
Thanks for having me, David. It's an unbelievable time in the marketplace, no question.
It is fascinating. And I was taught early in my career, as a technical analyst, your phone always rings more in a bear market than a bull market. And I think we're probably both experiencing that. This is when people recognize some gaps in their investment process because the market teaches some painful lessons. You have a series of charts you brought with us, starting with the S&P. How are you seeing the broader market here?
Well, I mean, we see here, I have the head and shoulders pattern that had been forming, after that initial decline we saw in the first couple months of the year. We had a nice rally in March, but that turned out to be a big head fake. And then we see what has happened since then. And just, at the beginning, last week, we broke below that neckline. And that's what's really taken us down here below 4,000 and towards that 3,800 level that you were talking about earlier. And what I completely agree with, that Fibonacci 38.2% retracement. We got pretty close to it today, about 38.50 intraday, but not on a closing basis. So this is a kind of distribution that we just makes things makes it very, very tough. And of course, the thing that you worry about is that when you get these kind of big sell-offs, especially in a situation where the market is very highly leveraged, that forced selling tends to kick in, and sometimes we even overshoot to the downside. So what's going on right now is a problem. The one thing I would say, though, is that we are seeing a few indications that we're starting to get a little washed out. I wouldn't be surprised if we see a bit of a bounce over a very short-term basis, but with the situation with inflation going on and the fact that the market has broken down some key levels, I think we'll see lower lows as we move through the year.
Yeah, it's certainly a distribution pattern that we've seen, and you've highlighted this beautiful breakdown. The question I always get, as I mentioned in our market recap, what actually is working? The dollar chart, not too bad here. What are we seeing next for the dollar?
Yeah, the one thing we have to be worried about is that, with this flight to quality situation, the dollar is obviously rallied very, very strongly, especially when you get places like China, which is, they're in a complete lockdown. And of course, Europe is in a situation where they have the war in Ukraine. So the one place to go for a flight to safety has been the dollar. That's the good side. The bad side, as you can see from this chart, is it come incredibly overbought. These are weekly charts, and the RSI is basically the most overbought it's been in over a decade. The Bollinger Bands chart, which means that it's 2 standard deviations above its 20-week moving average, and that's taking place at a time where it's testing kind of a double top. It's slightly higher than the 2020 top, but that high from early 2017. When things test a key support or either support or resistance, in this case resistance, and it's very overbought, it usually needs to pull back a little bit before, and kind of digest those gains before it takes a real run at breaking out. So for those who are trading the dollar, you want to be real careful here about being on the buy side. Besides, everybody's bullish. The sentiment is incredibly strong in the dollar. You might be careful. On the flip side, the euro is incredibly oversold. The yen is incredibly oversold. Sentiment is very, very negative. So they're getting ripe for bounces. So be careful, at least over the next couple of weeks in the currency markets.
Yeah, point really well taken. The dollar breaking higher, sort of flip that over. You get the euro that's really come off and certainly potentially poised for a bounce. Now, a lot of eyes on the fixed income markets, obviously with the Fed meeting last week and trying to understand and interpret what's going on here. What do you see in the fixed income markets?
Well, the same type of thing. I mean, with the as much as the dollar is overbought, the TLT, which of course measures the price of bonds, is oversold. And if you look at a chart on the yield, it's very overbought because obviously when the price goes down, yield goes up. And one of the reasons why I think people, even think about, at least on a trading basis, for a bounce in the TLT is, number one, very, very oversold. Number two, we've seen a kind of a flight to quality in this one. Back in February, in the second half of February, when the stock market was really selling off, the bond market did rally. It wasn't just the dollar that saw the flight to quality trade. When things get really ugly in the stock market like they have recently, that they also go into treasury bonds, and that has been rallying a little bit. I think that rally could last for a little bit longer. I mean, there are some people, very smart people, are saying they think the high in interest rates is here for a while. That could be the case. Either way, I doubt they're coming down a lot. But for short-term traders, I think there's going to be a tradable bounce here.
We only about 30 seconds left, Matt, but I did want to get to your last chart, DVN. Some of these energy names have obviously had an incredibly good run. Is there more upside to be had in this space, or have we missed the move?
No, I don't think we missed the move. I mean, we'll pullbacks all the time, say from time to time, I should say. But Devon Energy still has a 7% yield, and it's only trading at 7 times earnings. And watch the stock here. I like it, but if it gets down to its 100-day moving average, for any reason, see how that's been just rock solid support. That's where we want to back up the truck, because I think with the war in Ukraine being a war of attrition now, it's going to last long. Prices are going to stay elevated, and Devon Energy is going to do really well.
Matt, that's a beautiful take. I love the rundown, and thanks for sharing some long-term charts to help put some of this noise into proper perspective. Listen, stay safe there in Boston. We'll talk to you again soon.
Thanks a lot, Dave. Talk to you soon.
That's Matt Maley. Matt's the editor of the Maley Report. I've known Matt and followed his work, and it was guys like Matt are the people I miss the most for my time in Boston. Enjoyed chatting with him about the markets, and you can see why. Just a great layout of what we're seeing. And I think his point is really well taken. Think of the charts that he was showing, the weekly chart of the dollar with an incredible run, but facing resistance overbought. The chart of the TLT rolling down, but oversold, right? That mean reversion can certainly be an opportunity to in the short term. The question, though, is how you relate that short-term mean reversion to the long-term trends. And I thought his chart of DBN, Devon Energy, is a beautiful illustration of a sector has been a long-term strong performer and the benefit of waiting for some of those pullbacks to the 100-day moving average. Great take there from Matt Maley from the Maley report. Let's continue on with our next segment, getting sentimental. What we love to do, a lot of the sentiment data, market sentiment data, survey data, volatility data is all updated Wednesday into Thursday. So Thursday shows a really good time to sort of take a look and see where some of those indicators are at. So let's take a look. And what we basically do, we're going to use my sentiment indicator watch list. We'll start with the VIX. So we're looking at volatility, looking at the S&P options market, look at a couple surveys, the AAII and the name exposure surveys. And then we'll look at put call ratios, which is a different way of thinking about the options market and looking at bets on the basically on the bullish and bearish side to see what they can tell us about how investors are positioned in those particular markets. You know, starting with the VIX, the benefit of looking at the volatility is to understand, you know, where the fear is, right, or when the fear emerges. That's why the VIX is often called the fear gauge, or the fear index, because higher volatility means higher uncertainty, and that often means higher fear. I would remind you, though, even on a day like today, the S&P and a lot of stocks down a little bit, volatility down a little bit as well. So it's not an inverse relationship. It's not like it's the S&P plotted upside down. But if you look at the history over the last 3 years, you can see that in general, when the market's selling off, you see a spike in volatility. When the market is rallying, you see a decline in volatility, because in general, sort of that slow and steady decline, a little more stable, a little more consistent. Investors are sort of steadily adding to their positions and riding things higher. The volatility comes down. When you panic, when you absolutely freak out and you want to go risk off, you usually don't panic and freak out and then very gently start to dial down your risk. You try to sell everything and just get out because it feels like the house is on fire. That's why the volatility will often spike as the market's selling off. And that 2020 sell-off February into March really is a perfect illustration of how the VIX can spike higher, how it can eclipse previous levels. So, you know, in 2019, a VIX of 20 was actually pretty high. All of a sudden, we go to 4 times that, with the VIX peaking out in the low 80s in March. So where are we at now? We're in a different, what I call a volatility regime. If you look at the last 6 months here, you can see starting sort of November, December of last year, we've settled into this range around 20 on the lower end, around 30 on the upper end. Those are those shaded areas that you see in blue, around 20, in orange, around 30. And you can see over time, when we've had a VIX above 30, that has usually been a fairly viable bounce. An extreme move in volatility, an excess of uncertainty, fear emerges, selling comes in, but as a result, the market moves a little bit higher soon afterwards. When the volatility gets very low, the VIX down to 20, usually that has been a tradable peak, right? Those have been the peaks before the market has rolled over. That has potentially changed now. And if you look at what the market is doing now and using the VIX, you can see that we broke above 30 actually a couple of weeks ago, and for the most part have remained above there. We had that bounce there in the first week in May, and you saw the VIX come off, but from there it's gone right back above 30. I would say as long as the VIX remains above 30, this is a market in a downtrend, right? This is excess fear, excess uncertainty, excess volatility usually means the market's going lower. If you would see the S&P start to rally, look to see if the VIX can get below 30, that would tell you at the very least, reevaluate where we're at and see if there's enough buying power that's emerging. See if a lot of the individual names are showing enough strength, indicating that this is a sustainable move. We're not seeing it yet, though. We're seeing the market move lower with the VIX above 30. Let's look at 2 surveys. The AAII survey is a series of a group of individual investors that are surveyed every week. You can see this week, bulls down from around 26% down to 24% and change. Bears actually down as well from over 50% down to 49%. Still, obviously, bears outnumbering bulls by about a 2-to-1 ratio. And that spread between the two, which is plotted at the bottom, that histogram shows you overall a 25% gap, bears minus bulls. So if you look, there's only 1 week in 2022 where bulls outnumbered bears, and that was on this bounce here in March. Other than that, it has been very much a feeling of bearish sentiment. If you look, that has been the case. If you look back at like 2007, 2008, that's sort of that rotation that you saw. This isn't necessarily a great gauge of a bottom. It's not like if the market rallies because there is a lightening of sentiment. And the reason why I'm telling you that is look at 2020. For much of that year, even after the market had recovered, it took until September, October, November of 2020 before the net sentiment turned more bullish. We remained, investors as a whole, this group of investors at least, remained fairly skeptical of the advances. So be careful about thinking of this on its own as a bottoming signal for the market. Really interesting chart to show you with here. This is the name exposure index. This is active investment managers that are surveyed on what their exposure is to the equity markets this week, coming down from over 55% last week to below 25%. That is a huge swing, one of the bigger swings that we've seen looking back at history, and also one of the lower levels that we've seen. We very rarely in this survey have gone below 0%, meaning net short equities. That's actually incredibly rare. But being below 40% on its own is actually a relatively small number of observations. We're going to bump that out just a little bit. We'll look back at like the last 15 years or so, and we can see how often the survey data has been this low. Back in 2020, we got below 25% and got down to single digits, but never down to zero. The other times, if you can see this blue sort of horizontal line, you can see the other times we've gotten this low. 2015, which was there briefly in late 2014 on that sell-off. In 2011, we had one of the most negative signals in history. It says the S&P pulled back to its 200-day moving average after coming off of the 2009 lows. But here's the problem, and this is when people say, all right, the name exposure index got this low. That only happens at short-term market bottoms. That's true in that it does happen there, but it also happens in more extended bear market phases. Look at 2008. You first started getting below this current level back in late 2007 as the market was actually topping out. From there, you had an extended period where the survey was this low. This told you money managers were very much at the exits and had gone full risk off. We're getting near and we're sort of in the range of where we were back there. That's the risk to the current thesis, if you're bullish at all. It's that we have more of an extended, drawn out downtrend like we did in 2008 into 2009. We need to wrap this show, folks, and go to the 3 in 30. Let's go through 3 charts in 3 minutes to help tell the story of this market environment. Here's chart number 1. When I'm looking for charts breaking out, I have a relatively small number of names that I could do in ETFs. It's things like energy and even consumer staples, right? Stocks like Hershey and others that are having these good runs and are breaking higher. Not a lot rotating higher. I would think some of the other staples like TAP comes to mind with a nice rotation to the upside. But the bad news is one of the better charts I'm seeing right now is the Ultra Pro Short QQQ, the SQQQ. If this was a stock, would you be interested in buying this? Maybe. It goes from a pattern of lower lows to higher lows, from lower highs to higher highs. This is a chart actually well above 2 upward sloping moving averages. I would be concerned if I'm bullish here and the fact that the short ETFs look that attractive coming off of the long-term lows. Chart number 2 is the name exposure index in our segment, Getting Sentimental. We talked about some of the common sentiment indicators that are out there. And when you look at the deep history, you can see that even though the name exposure index is relatively low versus the last year, in more drawn out bear phases, the survey can actually remain fairly low for a long period of time. It's actually in a small number of occurrences even gone below zero, indicating that money managers in that survey are net short. We're not there yet. We're down to 24%, which puts us in the lower range of observations, but still could be in line with previous more drawn out bear market phases. Finally, I thought my guest today, Matt Maley, did a really good job outlining some of the the longer term trends that we've seen, the distribution in stocks, but also some of the signs of mean reversion. What I was taught going through some of these previous bear market challenging cycles like 2001, 2002, like 2008, 2009, even 2015, 2011, you get this sort of environment where it feels like everything's going down, but you will find a lot of things where the relative strength is improving. That's the pattern you're seeing right now with the XLV, the healthcare ETF. Right now, the XLV is testing support. If you go back over the last year, this has been a common support level, sort of in the 124 to 160, 126 range. What I am impressed with the most, though, is the improving relative strength. Starting in November of last year, look how the relative strength has been going higher. Those are the types of charts I would be most keen on focusing on in this uncertain environment. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close for the Final Bar. All of our previous episodes and interviews can be found for free at StockChartsTV.com. Special thank you to Matt Maley, joining us from the Maley Report in Boston. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.